Canada's financial regulator raised the amount of capital that the big six banks must hold as a stability buffer. So the Office of the Superintendent of Financial Institutions cited high household and corporate debt levels, also talked about global uncertainty. Our guest says this increase in the capital that banks must set aside is not terribly surprising, but it could, down the road, possibly lead to some unintended consequences. We're joined by John Aiken, Head of Research for Canada at Barclays. So first off, just the OSFI is obviously trying to head off future problems,
Correct.
In particular defaults on loans.
Yes, and so what the regulator is trying to do is put in an additional buffer, a higher buffer level, so that if we actually do have some credit issues, it's not going to be a concern in terms of the solvency of the banks. And this is, as we're all worried about, leading into the potential for a recession, which then credit losses will accumulate, you'll have a drag on earnings, and theoretically you can actually have a drawdown on capital.
That's interesting. So, and this, I mean, we should remember that banks are incredibly leveraged creatures, aren't
Correct.
they? And they like to set aside very little money in equity as a buffer. And if there's a run on a bank, it collapses.
Correct.
But, well, we have deposit insurance. So, but this does directly affect the profitability of banks, doesn't it, when they have to set aside more money?
Yes, it does, because obviously then when you're putting more capital or retaining more capital in the business, your profitability on an ROE or return on equity basis declines. Now, the funny thing about this, though, is that the regulator increased the buffer. It's not going to take place until November 1st of this year, which means it's not going to be until first quarter reporting for the banks in 2024. So they've got 3 quarters to come up at this level. Now, currently, all the Canadian banks are well above the 11.5% range. The only one that's a potential is Royal Bank, because they still have to close the acquisition of HSBC Canada. We don't know exactly what the capital hit is going to be, but based on our back-of-the-envelope calculations, Royal should be fine. And with an additional 2 to 3 quarters, we do believe that all the Canadian banks will be above 12% CET1 ratio, whereas right now the regulator pro forma is requiring them to be 11.5%.
The odd effect, though, here, and you're saying this, there's no certainty this could happen, but if the banks did have big loan losses, it would erode their capital because it would eat into their equity. And so then they could find themselves offside of these new tighter rules in a recession.
Correct. So what you're going to see is, if we have a deep and prolonged recession, which is not our base case scenario, not our call, but yes, then you could see a decline in earnings such that you could actually see negative earnings, a decrease in capital, or as you see loan losses go through, the mechanics of the capital ratio is the risk-weighted assets, which is part of the equation, would actually increase. So both lower earnings and higher risk-weighted assets will decrease the capital ratio, and as the banks approach that 11.5%, they would be forced to raise capital to maintain. But what we have seen in the past, though, is that the regulator then, in times of stress, will lessen the stability buffer, and we'll actually see that 11.5% decline, presumably before the banks will be forced to issue capital.
Forced to issue capital at what could be a low, depressed share price.
Absolutely. So we've seen the bank valuations under pressure, but if we actually do hit a deep recession, obviously the valuation multiples will recede a little bit more. And what we saw through the global financial crisis is the Canadian banks were actually raising capital at 1x book, in and around, which is a lot lower than where they typically trade, which is north of 2x book.
That's back in 07, 08.
Yes.
So, well, I remember BMO briefly went to a yield of 10%.
And actually, BMO was the only bank that actually raised capital slightly below book value.
Oh, I see. They were just out of favor at that stage.
Absolutely, yes.
Yeah. You have a fascinating chart in your report. TD is awash in capital, it looks like. They've got a ratio north of 15%. But that's because First Horizon, that deal didn't go through.
Yeah, so what TD had been accumulating capital because the First Horizon was going to be a very significant drag on its capital ratio. So now, actually, almost ironically, because the transaction didn't go through, TD is sitting here heading into a potential recession with the strongest capital level, well above the peer group that are on average just under 13%. If you include national, that the rest of them are just hovering around 12%. And this actually puts it in very good stead, because if you're concerned about the banks in a potential recession, then obviously you're going to want more capital rather than less. And we're actually starting to see investors warm up to TD because of that, even though they don't have the same growth profiles they would have pro forma the First Horizon acquisition.
But there is an opportunity cost here. It means a lower return on equity.
Yes, absolutely. But one of the interesting intricacies with TD is because it's being very acquisitive, its ROE is actually being one of the lower out of the group.
Ah.
And even though it typically trades at one of the higher valuation multiple premiums. So on a near-term basis, ROE is not necessarily as important for investors when they're trying to ascribe valuation. It's actually who's going to grow the fastest in normal environment. Today, investors are saying, okay, who is the most bulletproof? Who's going to be able to weather the storm and be able to maintain their dividend, even though we firmly believe that the last thing a Canadian bank will ever want to do is cut its dividend?
It looks to me like BMO, Scotia and CIBC, according to your research, are closest to the minimum capital level.
Correct.
So could they be forced into a capital raise?
Potentially. But right now, with them at base, CIBC is the only one that's below 12%. But basically, with all of them 50 basis points above the regulatory capital, we do think that 12% is going to be the de facto market minimum. And because they still have a couple quarters to accumulate internally generated capital, we think they're going to be fine. But if the recession is faster and harder than we anticipate, yes, you could potentially see those three be forced to raise. But right now, as we said, we don't expect that to happen.
Actually, you've reminded me of something there. OSFI has also given the banks a warning that it's watching them as they bail out customers who've got these variable mortgage rates. They're extending the amortization because I guess the last thing banks want to do is foreclose on someone.
Absolutely. So the Canadian banking market is very different than what we see globally, and particularly in the U.S., where a Canadian bank customer basically has more than just one product with them. And if you force somebody into foreclosure, the bank then risks losing all the other products, particularly deposits, which are very profitable for the banks. And so you see a willingness for the banks to be able to work with their customers and the client base and not force them into that. Now, of course, the regulator has to keep a watch on this, and we're probably going to see ongoing stories over the next 12 months in terms of whether or not the Canadian households are being stretched too far, amortization periods are being pushed too far. But end of the day, right now, what we're hearing from the banks and what we're seeing anecdotally is, yes, there is pressure, but that's more the exception than the norm.
And John, before we let you go, what are your ratings on the banks? What bank stocks do you rate by, for example?
Right now, we actually are reasonably neutral on the sector.
Okay.
And actually, I think what we highlight is we have underweights on Royal and National, largely just because their valuations, we believe, are a bit stretched.
Okay.
Not that we think that they're in any operational difficulty, but we do think that with the pending recession, you're going to see pressure on their valuation multiples, and those are the ones that stick out most.
You're cautious. But what about an investor, though, who had a decade or two time frame?
Well, then you could basically choose any of the banks because they are very well-run organizations. It's safe, but right now we do have buy on BMO because we're very favorable on the acquisition of Bank of the West.